why do you think that investors fail to ask the right questions?
Well, Bethany, the reason investors and their advisors fail to ask the right questions are because they don't have a game plan. They manage their portfolio one way, offensively. The problem with playing offense and being invested in the market 100% of the time, it's just not a game plan. Playing offense 100% of the time and never selling means you will ride the market up and ride it all the way back down again. Since 2000, the Standard & Poor's 500 has had drops of 20% 3 times and rises of more than 20% twice. Investors and their advisors employing the buy and hold philosophy have been whipsawed by the market. 12 years later, their portfolios are near or below their original investment, excluding inflation. That's if they didn't hit the panic button in 2000 and 2008.
So is this a new problem or one that has always existed?
This isn't a new problem. This is a problem that's been around for many decades and will continue to be around for many decades until advisors and investors understand that there are alternatives out there in the marketplace today.
And actually, can I follow up on that one with what are
Sure.
the alternatives?
That's what we're going to speak about today.
Okay. So is this the cause of most bad investing, or is there a greater root cause behind it?
I believe it's one of the greatest root causes that are out there today. Investors and their advisors, I believe, are not asking the right question. The first thing that most of them do is they try to invest into the market immediately. I believe you should ask one question first and foremost, and that is, who has the ball?
So are these problems unique to physicians?
These problems aren't unique to physicians. However, I believe physicians have a more difficult time than the average investor out there managing their investment and retirement portfolios. The reason being, they have time constraints. Their time constraints by having heavy loads of patients, the paperwork that is out there today. Physicians are a very extremely intelligent and bright group of individuals. They have the capabilities to manage their portfolios themselves. But the problem is they don't have the time.
So which is the most important index for investors to routinely check? You talk a lot about the bullish percent index in this article.
The most important index for investors to check is the New York Stock Exchange Bullish Percent Index, in my opinion. It was developed in 1955 by a gentleman named A.W. Cohen, who was the first editor of Chartcraft. And what he was searching for at that time was an index that would tell him when the market was bearish at the top and bullish at the bottom. Obviously, today, when you are watching the news, it is more bullish at the top of the market, and it's always bearish when you're at the bottom of the market. It's counterintuitive, and I happen to believe that success is counterintuitive in the investment world.
My follow-up to that question is, it seems like doing something that's counterintuitive would make the novice investor feel a little bit uncomfortable.
You can feel uncomfortable at that time, but I think you need to educate yourself. And your advisor needs to educate themselves, which in turn, they can educate the individual investor on what they are trying to do. As I mentioned to your very first question, the majority of advisors and the majority of investors that are out there do not have a game plan. You need to have a game plan for when things are going well and when things are not going as well.
All right, so how often should an investor tweak his or her portfolio, and does that change depending on whether you're doing it yourself or having someone else do it for you?
I think an investor should change their portfolio as the market dictates the changes should happen. One of the most ridiculous things that we have in the investment world is they tell investors and advisors to change your portfolio on a predetermined time frame. I find that the most ridiculous thing out there. What investors should do is turn to the bullish percent index, which will tell you who has the ball and what actions you should take with your portfolio.
So now we'll start with your Olympics analogy in case someone didn't read the article, and then start with
Sure. The reason I wrote about the Olympics is that they are a current event. The whole world will be watching. And that's the way the United States chooses their Olympics for the athletes for their Olympic team. I believe investors should choose their investments for their portfolio the exact same way. The reason we took a look at the Olympics is there are 5 rings to the Olympics, and there are 5 rings to our investment philosophy. There are 5 steps. The first ring, we evaluate what the market is to determine who has the ball. If we have possession of the ball, we then turn to the offensive playbook that we have. If it shows that we have defensive team on the field, we then turned our defensive playbook. The second ring is where we evaluate the sectors to determine, once again, who has the possession of the football. Fundamental stock evaluation is the third ring. Here we use fundamental analysis to determine what to buy. That is usually where most investors start with what to buy. They surpass the first two steps, which are possibly, in my opinion, the most important steps that you should have in a portfolio. The fourth ring is the technical stock evaluation. This is a step where we determine when to buy. When to buy fundamentally sound stocks and determine the risk reward going forward. That is also an important step that most investors do not look at. The fifth and final ring is rather simple, but once again, a very important step in the process. You need to have a game plan for when things go correct and when things go awry. There are going to be times that you have possession of the football and you score. There are also going to be times when you fumble the football, lose possession, and the market starts taking money away from you. You need to have a game plan to know exactly what to do. We do that with our investments on a daily basis. If you grab a hold, in my opinion, of these 5 rings, you may soon be standing on the podium with a gold medal winning portfolio.
I do have a couple follow-up questions then.
Sure.
The question is, though, so what happens if you've already dived deep into the portfolio and you've done a poor job? Can you dig your way, get your way out of this hole? Is there a way to start back at this?
Yes, you can. If an individual, and I think the question that you're asking me is if an individual has a portfolio that we would consider underwater, that is substantially down in the portfolio, is there a way to climb themselves back up and make it into a portfolio that can obviously make dollars and cents in their pocket? I believe that you can. Once again, you have to start with the individual philosophy of the 5 steps. You go back to the very first step once again. Review the portfolio. Let's take, for instance, that the market is on defense at this point in time, which as of today we are. Market's on defense. The very next thing we do is we look at the securities in your portfolio, whether they be exchange-traded funds, mutual funds, or individual securities. And the first thing that we look at is what sector are they in. And if they are in a sector that has possession of the football, we will then stay in that individual security. If that sector does not have possession of the football, you should sell that security. There is no reason to hold on to a security that is not performing up with the market. We wrote about that in the article that was published in March called How Are Your Investments Seated? That was in Medical Economics.
Do you find that you sometimes have clients, though, who have sort of sentimental attachments to certain things within their portfolio and they have trouble letting go of those things? That
happens a lot. But with these indicators that we utilize, they are what we call soulless indicators, that there is no emotion involved. When you are investing, that is probably where you would ask the question previously, what are the root causes of investors having bad portfolio performance? Becoming emotionally attached is one of the causes. However, if an investor is looking at a gold medal winning portfolio, they will do the sacrifices that the Olympic athletes do to get to that gold medal.
Do you have any tips on places that a physician who's doing this for themselves can turn to find appropriate information to make these decisions?
One of the greatest places that a physician could go to, I would first recommend purchasing a book that is by a gentleman named Thomas Dorsey. I actually have a copy of the book right here. It's called Point and Figure Charting. This is the Bible on point and figure charting. Tom Dorsey also has a website. It is www.dorseyWright.com that you can go and have a free 2-week trial, and you can learn a lot of the ins and outs of the process. Just like anything else, it takes years in order to become a craftsman in this philosophy. I actually started utilizing this philosophy in 1997. We were able to miss the market crash of 2008. We missed the market crash of 2002, and we missed the market crash of 2008. So this philosophy does work. Once again, do not become emotionally attached to your investments. And that's a very difficult thing to do.
Do you have anything else that you think is important to add?
That's a tough question. I could sit here and talk for hours about that. I think we've pretty much covered it. When you're dealing with investments, just to try kind of recap, number one, if you have possession of the football, know which plays you're going to run, offensive or defensive plays. And try to think of yourself, as opposed to being emotionally attached, try to think of yourself as a Bill Belichick. He is an unemotional football coach. He is a Super Bowl winning football coach, not once but several times over. Those of us in Cleveland possibly don't feel very, very good about him, but the guy is a success. And he is not emotional with his way he coaches, and also he's not emotional with his investing.
Talk to me a little bit about your interest in tying sports to finance.
Being an ex-athlete, tying sports to finance, I think, is very important. And for me, it makes a lot of sense. And we also, at different times, try to take what is happening out there when we are writing articles and trying to educate the individual investor, and especially in this case, the physician. We try to look at different areas to put finance into things that they can understand that are happening out in the world. Right now, we're getting ready to write an article concerning the presidential election and how that relates to finances. There's also a point-and-figure chart detailing both of the political parties that are running for president. That is a very interesting concept that is out there. We also have are researching or looking at writing articles about how sailing is like investing, how poker is like investing. You can bring in any different analogies to look at. Once again, what we're trying to do first and foremost is educate the investor so they know there are alternatives that are out there, that they don't have to get their investment advice from CNBC or Fox Business News or the local newspaper.
Do you actually give these analogies in person to your clients?
Yes. I have one local physician that has been a long-term friend and a long-term client, and when we talk, the first question he asks me is, who's got the ball?
And let's get a little bit about your background. So what did you major in? How did you end up in finance?
I basically got interested in investing because of my economics professor, Dr. Gregory Pett at Baldwin Wallace College. Mm-hmm. And his teaching enabled me to become interested in something that has become a lifelong passion and obviously a career path.